Okay, we are on 10 o'clock. We have a kind of 100 people signed on for this webinar, so there's a few more people that are going to join us, but we will share the recording and maybe just kick off with some introductions. So welcome everybody. Thank you so much for being with us today. This webinar is all you need to know about the latest developments in transfer pricing, and we're touching on corporate tax, the wonderful corporate tax in the UAE. For those of you who don't know us, I'm Cabrini McCarrick. I'm the transfer pricing partner at Regan van Rooy. I hail originally from Ireland and spend a lot of time in Africa. My journey was as a lawyer and then qualified as a chartered accountant in Deloitte, London. And then I had the pleasure to move across to Johannesburg and work on transfer pricing largely across Africa, the UAE, and into Europe. I also have Tuli with me. She's an associate director at Regan van Rooy, also a chartered accountant. So we're both really fun people. And she previously worked at PwC and also in-house at a major multinational. A little bit about Regan van Rooy. Again, I think quite a few of you have worked with us in the past or still work with us, we're blessed to say, but we've been knocking around since back in 2016. We focus on all things tax, transfer pricing and structuring. We operate kind of across the globe, with Africa being obviously our key market. And we have offices in South Africa, Mauritius, Portugal, and Ireland. So what will we be covering on today? So we are going to start with a little bit of the basics in terms of what is transfer pricing. It might be a little bit boring for some people, but our audience is quite varied. So we want to cover some key topics there. Global trends, and we can't talk about global trends without, mentioning these wonderful pillars that are knocking about these days. And then Tuli is going to give us a real deep dive into the UAE transfer pricing legislation, what we're seeing happening on the ground there, and hopefully how to help you all kind of tackle this new layer, relatively new layer of massive compliance obligations and reporting requirements. Okay, so what is transfer pricing? Transfer pricing has obviously been around for a long, long time, but why has it evolved so significantly in recent years? That is because business has changed and the perception around tax and tax transparency has changed. So essentially business, there's an increased internationalization in business, which means there's a lot of complexity around multinational group structures. Of course, this brings heightened scrutiny from the tax authority, essentially looking at how do we deal with our connected persons within a group? How do we transact with each other, and does it align with global best practices and the strict arm's length legislation that is across the globe? A massive driver for this is, of course, the base erosion and profit shifting project and the OECD. So all of this work that has been done globally has essentially created a new wave of updated transfer pricing legislation, including brand new corporate tax and transfer pricing legislation in the UAE. And that's been kind of implemented on a global basis. Whilst the UAE is new in terms of didn't have transfer pricing documentation rules before, it's important to note that everywhere globally, the rules are still changing and they're being updated to adhere to all the best practices. If we think about in the last 2 months, Austria, Denmark, and Germany have all updated their legislation again. So it's quite a moving target. It's all going in one direction, and that direction is you need to be compliant. You need to tax at arm's length. Tax needs to be paid fairly in each jurisdictions that you operate in. And the world kind of globally is looking for tax transparency. So essentially, as the business world is evolving, the UAE tax law has caught up. They have initiated this legislation. The legislation is clear, the legislation is in place, and the legislation is actionable. So what is transfer pricing? We say it's the cornerstone of international tax, right? So international tax is meaningless without transfer pricing. Transfer pricing is integral to the business model and operations because it essentially has an impact on where profits are realized and how tax is paid between groups, of course. So when we're dealing with related parties. Essentially, transfer pricing then creates a bit of a tug of war, because we're dealing with multiple or more than one tax jurisdiction, and each one wants to get their fair share of the tax base. So that means they're interested in both sides of the border. While in the UAE, this is new, and the UAE have kind of, ignored transfer pricing to date. Now, all of a sudden, they're becoming interested in what's happening there. What is the nature of the transactions? What is actually happening? So it's quite interesting. And the UAE specifically is interesting because it's still what we would call, obviously, it's a lower tax jurisdiction. So normally the risk lies in the other jurisdictions, right? Normally we would say if you're dealing with other African or European countries, normally the case is that business structures are set up not to have too little profits in the UAE, but rather to have a maximum amount of profits in the UAE. So there's a slightly different slant on risk and how we have to deal with transfer pricing when we come to the UAE. And the biggest focus of kind of the globally will be substance. Do we have the substance in place in the UAE to support the models that we have in place? And what should that substance look like? The key concept of transfer pricing is that profit should follow value creation. So that's a big statement. It's an important statement, but that's ultimately what transfer pricing is looking at. The complexity, of course, is determining how and where value is created in a supply chain. And ultimately, that's the journey that your transfer pricing documentation takes. Tuli's going to talk you through what goes into this local file, master file that you now have to prepare in the UAE. And, how do we talk about our value chain and our business operations? It's very holistic in terms of business, what actually goes into your transfer pricing documentation. Of course, the main focus on transfer pricing, when we say what it really is we're generally looking at cross-border transactions between associated enterprises, which is various definitions, and Tuli will talk us through the UAE one, and whether or not those transactions are arm's length. There is also domestic rules. Tuli will also talk about, the domestic implications in UAE, but globally there is also domestic rules when we transact between two different legal entities in the same jurisdiction. But cross-border transactions is generally the most important. So we talk about this concept of arm's length, and it's globally defined, it's globally accepted, but this is how we essentially need to transact with our connected parties. Simply put, we transact with them in the same way that we would transact with a third party. Sometimes people say, but of course we do. But the nature of groups and businesses that actually we often don't. We often don't exactly transact with connected parties with connected parties in the same way as third parties for various different reasons. So we do need to look at this, look at how we transact with third parties and related parties and ensure that we are compliant with this principle. So essentially, when it comes to transfer pricing, the kind of original onus is on the taxpayer to evidence that they transacted an arm's length basis. And this isn't just a kind of on trust or whatever way we think we can prove it. There's a specific way that we have to evidence it. And that's within our local and our master file through various forms of documentation, financial data, and legal agreements. There is a big focus on economic substance over legal form. So often people as a basis will say, this is our legal agreement and this is how our transactions are structured. And in accordance with the legal agreement, it's fine. But obviously the whole base erosion and profit shifting project and the documentation process across the globe is actually placing back the focus on what's happening in reality on the ground. And when we talk about substance, how we evidence that. So substance is something where we look at the economic substance of what happens. Do we have the significant people function in place that are controlling and managing and have the capability to control and manage certain functions, assets, and risks? When we talked about it earlier, we said we have to look at where value is created. That's linked to substance. And ultimately, it's not about the number of significant people functions you might have, but you have to have the right significant people function to manage and control the risk to which the profit of that entity, when it comes to related party transactions, relates to. So that means that there is a big focus on value chain and key value driver analysis and what and how the business works. So why does this all matter? It sounds quite broad. It matters because it's this fact pattern and the economic reality of the business and its transactions that actually underpins what amounts to an arm's length remuneration. So without understanding kind of some of these bigger picture concepts, it's difficult to determine what's arm's length. So to put this quite simply, with transfer pricing, we're looking at who does what. And remember, we're talking about a group, connected parties. So who does what? What is the economic significance of what they do in the value chain? How much remuneration do they earn? And can we conclude that that is arm's length? In general, as we mentioned, the OECD governs all of these principles, and the UAE, their rules are aligned. So all of this, what's kind of been happening globally, is now, I guess, at our doorstep in the UAE. And it's kind of more important because it really hasn't been looked at in any type of detail before this. So what influences TP? It's obviously what we have coming externally is new legislation everywhere. So everybody kind of scratching their head to make sure that they're getting up to speed. Tax authorities then, really looking at this. So we're seeing everywhere TP audits. TP audits is the one thing that keeps me and Tuli in a job. They're the biggest headache for a client, but it is rampant. It is rampant. Every tax authority from Lesotho to the bigger tax authorities to the HMRC, audits is kind of the focus, because what the world is saying is, you've had this transfer pricing legislation. Now we're going to come and check if you're actually applying these principles in practice. Internally, what does this mean for us, and particularly with UAE businesses? It means we have a total change in our compliance burden. We now have to do a load of extra stuff we just didn't have to do before. We have to prepare our documentation. We have TP disclosure forms. We have to do all sorts of different things. When it comes to Pillar 2, we don't even want to delve into that just yet, but there's loads of different reporting requirements that were not required before. So it means we have to, spend quite a bit of time focusing on how do we manage this? How do we manage this additional compliance burden? The other thing that's happening is actually rethinking how we do business. And we're seeing this happening now within the UAE, where we didn't have to think about transfer pricing before. That sometimes means that the model, the business model, and the underlying transfer pricing model that we had in place doesn't stand up rather, to the new rules in international tax around transfer pricing. So there's a lot of assessing that, what are we actually doing? Is this actually supportable? But that's also applicable in the free zone areas. That's a big thing. That's not just a compliance thing. That's, do I have to look at my business model and look at my transaction flows, and do I need to make a change that's going to substantially impact my business? There's then this alignment of business and TP models. So when we do the value chain analysis and we're looking at who really does what, you have to have an alignment. You have to check that it's sensible and makes sense and will stand up to scrutiny on both sides of the border, or multiple sides of the border, as the case is often. Previously, transfer pricing was much more theoretical. People would do their file and they would literally stick it on the shelf, or they wouldn't do their file and they'd hope that nobody would ask them about it. But now implementation of this is key. And how do they check implementation? It is literally do your numbers, match your legal agreement, match your documentation. And if I interview people within your business, are they going to say the same stuff as you're saying in your file? Sounds simple, right? But actually getting a coherence and consistency across all those different data sources that a tax authority now has in hand is pretty tricky. But implementation is, essentially, obviously critical to getting past the initial layer of compliance. Well, we talked about this, the reconciliation of the data, right? We have the tax returns, we have the TP disclosures, you have your local files, you have your practice on the ground, you have your financials. And we also have this sharing of information between tax authorities. So we have all this new level of information that people are looking at and people are scrutinizing that haven't been looked at before. And often we will know ourselves, they're not perfect and sometimes they don't match. So if you're in an audit type of process, that is the type of thing you need to be starting to think about. Who cares about transfer pricing? Hopefully a couple of people on this webinar cares. We like to think that we care, but it's quite wide. The tax authorities and the global regulatory bodies. If you're in a highly regulatory industry, right, this is obviously critical. The tax authorities are all over this. Taxpayers, obviously, and this is not just a tax issue, it goes beyond that to the C-suite. Why? Because ultimately transfer pricing is looking at very, very high value risks or exposures, not just compliance, but also where your profit falls and what your effective tax rates are. Your stakeholders and the public. Why do they care? Because there's been so much case law around this. It's in the news. Tuli will talk to you about some of the places the UAE and TP is popping up in the news. But if you're on the wrong side of transfer pricing, it tends to have very wide-ranging reputational considerations because nobody wants to be seen involved in this concept of profit shifting. It's not a good look for a business. So it's kind of across the board, the transfer pricing has become a hot topic. So it's not just about compliance and risk management. There is also business model optimization opportunities when we look at transfer pricing, but it has to have the right setup, it has to have the right substance, it has to have the right narrative and fact pattern on the ground. For those who are not so familiar with transfer pricing, what are the type of transactions we look at? It's any transaction between connected parties, but simply put, that's services, the sale of goods, the provision of services, anything around intellectual property. Is there shared know-how? Is there shared brand? Is there shared manufacturing know-how? Whatever it might be, and financial transactions. So they're generally all the type of kind of transactions that happens across a business. Tax authorities are looking at many things, but the obvious ones are loss-making entities, substance, back-to-back or non-commercially realistic transactions. Remember, there has to be a commercial rationale for entering into a transaction, and that should be substantiated. High-value transactions will always be the one that the tax authorities care about. And if most of what we do as a business is related parties, so if we buy or sell all of our goods to or from a related party, all of our profits is connected to transfer pricing or losses, as the case may be. So there's quite a substantial focus on that. Finally, and before we get into really more detail on the UAE itself, I just want to talk a little bit about the transfer pricing life cycle, because it is a life cycle, it's ongoing, right? You have an annual compliance obligation. You've got to implement it on the ground and you have to have the documentation to show it. So typically in jurisdictions where a transfer pricing is new, there has to be a very comprehensive sense check of what we're currently doing, right? So we call this policy design, planning and health check, really assessing what we're actually doing. When you've figured out that you've got supportable policies and you know what your policy is, you're doing your compliance, that's your documentation and your benchmarking. And often one of the difficulties when we're starting documentation for the first time is that we actually need to make changes before we want to document it, because this document is a document that's suitable for a tax authority. And often when we're lifting up the bonnet and checking under the hood, we'll find actually we didn't charge a markup on these services. Actually, we didn't charge any interest on these loans. We have certain exposures. We need to do certain analysis to fix that. How do we manage that? You know, do we tell the tax authority? Do we make a TP adjustment? There's lots of strategies and thinking around that. Do we try and fix it in the first open financial year? We need to understand that there's a lot of understanding that goes into, you know, your first time you're doing documentation in a jurisdiction. And then we want to document. Ideally, you want your local file to be documenting, where possible, a nice perfect model where you have the benchmark, you have the policy, you know it's supportable, and you have the numbers to match it. Then what's happening now, and it's becoming almost typical, is that there will be some type of an information request on your document, with requesting your documentation if it's not been submitted, requesting your legal agreements that will turn into potentially a dispute or certainly a back and forth with the tax authority. And how do we manage those situations? How do we understand them as a group and manage our risk profile as a group? Across all of this life cycle is what we call operational TP. And that means actually doing what we say in the file. If we're saying we calculate the cost base like this, how do we do it? When do we invoice? Do we invoice? Do we just account for it? Or how do we do it? But it's literally how we do this in practice using our own systems and monitoring tools to make sure that we're applying the policies correctly. Obviously, things like transfer pricing adjustments, if we're limited risk or other types of models require much more in terms of operational GP. They're more complex and some are more simple. And then there's, of course, ongoing implementation and monitoring. You now have to report on these items on an annual basis. In the UAE, of course, if you meet certain thresholds, but even if you don't meet those thresholds, the rules in terms of you have to transact on an arm's length basis still apply. So you might be exempt from immediate documentation, but you're not exempt from actually implementing these laws within the context of your business. So it's an ongoing life cycle. Very briefly on global trends before we hand it over to you, Tuli. Obviously, there's a lot happening, and Pillar 1 and Pillar 2, it's actually all around transfer pricing to many extents, right? Pillar 2 is on a little bit of a hold, or Pillar 1 is on a little bit of a hold, and the UAE is not having too much to say about that at the minute. But Pillar 2, which is basically global minimum tax, we've gone to a 9%, and now we have this potential domestic top up to 15%. That has massive implications on groups now, and there is a lot of planning that we need to do about that and figure out how's that going to impact our business. Is our business model still aligned with our commercial goals? What are our reporting requirements? There's so much going on there, but understanding what's happening there is key. In general, across the globe, as we've mentioned, is disputes. One of the mechanisms that's increasing in importance, but is only suitable in certain instances, is advanced pricing arrangements. In Africa and the UAE, whilst we have rules around it, we don't think we're going to see much actual APAs on the ground in the short term. There's definitely an ongoing scrutiny on intellectual property, and the big one is increase on tax transparency and compliance through the suite of information that we now have to submit to tax authorities and the information sharing that has been signed up on a global basis. From a wider corporate tax, I think you all know with UAE businesses, that's a shift in itself. Okay, we have to pay a bit of tax, not so terrible. How do we line that up to our systems? Do we have the documentation to implement that? All of that. So there's a bit of a headache in terms of, dealing with such fundamental changes in the UAE and making sure you have the right resources in-house to manage this and making sure that you are up to speed. One thing we know about the UAE and the businesses in UAE and the tax authority in the UAE is that compliance and the letter of the law is absolutely critical there. We've had many requests from auditors already. They won't sign off on the financials without the TP document. In other countries, it's been years before the auditors caught up with things like that. So kind of doing everything correct is really critical, and it is the way that businesses have been operating in the UAE for a long time. So it's not something that can be long-fingered or put off. Global trends also a stronger focus on substance and anti-avoidance avoidance rules, and generally on this minimum tax and tax transparency, and making sure that we are kind of coherent, sensible and responsible taxpayers. So lots happening. And now I'm going to hand it over to Tuli, who's going to talk specific on the UAE legislation and regulations. Tuli, I'm moving your slide, so you let me know when you want to move, but over to you. Thank you.
Sure thing. Thank you, Cabrini, and good morning again to everyone. Thank you for joining us. So very briefly, this slide is just showing us a roadmap of the various developments that there have been in the UAE in terms of transfer pricing. So this is, I mean, it's a number of new things that have happened, and this is only the past 2 years that we've covered here. So as we can see, it started off with the ministerial decision number 97 of 2023 regarding transfer pricing documentation. Cabrini, if you can just move down a couple of slides to where we have the tables that just speak more to the detail around this slide. We'll go back up to the top. It's a little bit further down, sorry. Thank you. So first up, we had the ministerial decision on transfer pricing documentation. So that was a formal introduction of TP documentation rules, and it was in line with the OECD BEPS actions. So that establishes when the master and local file must be prepared. So Cabrini has spoken a lot about TP documentation. So that's quite like a wide term. So in terms of the OECD, there's a three-tier documentation requirements. We've got the master and local file, and those are required for a taxpayer where the consolidated group revenue is at least 3.15 billion dirham, or the entity, the UAE entity itself, has a revenue of at least 200 million dirham. So those are the thresholds that are required. And then this relates to all UAE entities within the scope of the corporate tax law and that meet the thresholds. And later on, we'll talk a little bit about any exemptions that may apply. Then we have the introduction of the Corporate Tax Guide TP disclosure. So that defines how related party and connected person transactions are reported in the corporate tax return by way of a TP disclosure form. So under that, there are thresholds as well of what must be disclosed. So the total transaction value with all related parties and connected persons. So transactions that are at least 40 million dirham each year, with each related party category being at least 4 million dirham. And then connected person transactions that are at least 500,000 dirham. So those thresholds that we've just gone through now relate to the TP disclosure form. And that is just for purposes of enhancing tax transparency. And then if you go to the next slide, please, Cabrini. Thank you. So then in January 2024, we had the corporate tax guide relating to tax groups. And that was just a provision that says if you are related parties that are tax resident in the United Arab Emirates, there's a provision for you to apply group tax rules whereby you are seen as one taxable person from a tax perspective, and therefore it simplifies the documentation requirements in that only one TP document, one set of documentation is required to cover all the groups, but there are conditions that are required to be met. So it's just important that taxpayers are aware of the existence of this provision, and just make sure that you're able to tick off all the requirements in order to simplify the compliance burden on that side. And then last year, December 2024, we saw the announcement of the advanced pricing arrangements being announced in Dubai. So we know that the unilateral APAs are expected to be accepted starting from the fourth quarter of this year, and with an expectation that there will also be bilateral and multilateral advanced pricing agreements in future. So this is also just in terms of transparency and certainty, trying to give some bit of certainty in order to also continue to bring foreign direct investment into the country, where there's that bit of certainty around the related party and covered and connected person transactions. And then lastly, as from January 2025, for all your tax years starting from 1 January 2025, the UAE has brought in the Pillar 2 domestic minimum top-up tax provisions, and this is applicable for the really bigger groups with a consolidated revenue of at least 750 million euro. Thanks, Cabrini. If you can just go back up to the start again. Sorry about that. Yes. So as we've mentioned already, the UAE TP has gone beyond just the tax authority. It's in the media, it's in the mainstream media. So some of the headlines we've seen speak to the fact that the UAE is already announced the start of TP audits. So as Cabrini mentioned before, the rules have been out there for some time, and now the tax authorities want to see that taxpayers are actually implementing them. And then also we've seen also, the UAE free zones, why TP documentation is key. So even if you're a free zone entity, firstly, it's not automatic that you would apply for, sorry, that you would that you would be considered for the free zone provisions, but you need to apply for them and meet the certain criteria around that. Cabrini, if you can just go to the next slide as well, just so we speak a little bit to that and see what the key themes were. So like we said, the first TP audits have been launched, are going to be launched. We expect these to target, amongst others, the high value cross-border transactions, especially those with affiliates and tax restrictions. But remembering that we did mention earlier that the UAE TP law does also apply to domestic rules. And then, as always, like we said, intangible related transfers, management of financing fees, research and development or marketing transactions, as well as any structuring risks, such as intragroup reallocations or centralized profit hubs. So those are ones that we think are going to be top of mind, but of course, everything is fair game. We've seen that the FTA has really strengthened its in-house TP expertise in order to be able to apply more rigorous scrutiny. So it's quite interesting that although the rules are relatively new in comparison to the rest of the world, the tax authority has quickly built up its muscle in order to be able to oversee that taxpayers are actually applying the rules. So I think it's important that we don't get comfortable and think that it's still new, but they actually have just hit the ground running, and like we've seen, they're already starting with the audits. And then also, like as we'll see throughout the presentation, there are a lot of uniqueness about the UAE rules when you compare them to the rest of the world. So there could be possibly, because this is the first time that they're going to be tested in terms of the audits that are going to be happening. So it's going to be quite interesting to see what kind of challenges pop up from both the taxpayers and the tax authority. Thanks, Cabrini. You can go to the next slide. So I think, as we're preparing for this, we mentioned that this is probably the most important slide of our entire presentation. Because what we all want to know is, what are we talking about, or what is required from me as a taxpayer? Who is in the scope of this, and when? When is it applicable, and when do I have to have complied? So firstly, what it is, it's compliance with the TP legislation and regulations, meaning you need to have transacted with your related parties and connected persons at arm's length. In order to prove that, you need to prepare your tax disclosure form. So that has to be done, as we'll see on the other side of the screen. The TP declaration, it has to be submitted together with your tax return. the corporate income tax return, and that is within 9 months after the financial year end. Then we also have TP documentation, the local file and the master file. We spoke briefly about the thresholds that apply, and that has to be prepared by the time that the tax return is submitted, but it is only submitted to the FTA within 30 days of request. But important that it must be prepared by the time that the tax return is submitted. And then the third layer of TP documentation that I mentioned briefly is the country by country report. And that by the end of the financial year, sorry, by 9 months after the financial year. So again, when you have to notify the FTA that you are within the scope of country by country reporting and will be submitting it. And that has to be submitted within 12 months after the reporting period. So who is in scope of this? That is all taxable persons who have cross-border or domestic transactions or arrangements with related parties or connected persons, subject to the thresholds that we mentioned previously. So if you are part of a multinational entity group with a consolidated revenue of at least 3.15 billion dirham, or a UAE tax resident legal entity with a revenue of at least 200 million dirham.
Tuli,
and then in terms of...
Sorry to interrupt, Tuli. I just wanted to add there'll be some people where we don't meet these thresholds. But what's important is that their laws also specifies if you don't meet those thresholds, you may not have a strict local master file compliance obligation, but you still have to adhere to the law. You still have to comply with the arm's length principle. So in those situations, we're recommending you at least assess your policies and document them in what we call a high-level policy file, or a high-level, so that you have something to defend your position. It's something we're also seeing auditors ask for, even when the thresholds are not breached, because that is now a specific part of the law and part of kind of ensuring that we're on track. Thanks, Julie.
Yes, thanks, Cabrini. Quite right. So just in terms of when these rules start to apply to you. So if you are a taxpayer with a financial year starting in July, or in other words, ending in June, these laws have been applicable to you from the 1st of July 2023. And then if you are a taxable person with a financial year end starting in January or ending in December, this has been applicable from the 1st of January 2025. Thanks, Cabrini. We can go to the next slide. Thanks. So what the legislation is saying, Article 34 of the Federal Decree Law talks about the arm's length principle, which we have touched on earlier. So it's saying that all your transactions with related parties and connected persons need to be on an arm's length basis, meaning akin to third parties. So this applies to all transactions. It can involve, the purchase and sale of goods, the provision of services, intangibles, financial arrangements, or dealings with a permanent establishment. And relevant taxable persons need to prepare TP documentation to evidence that they have stuck to the arm's length principle. And if you don't, you may be subject to TP adjustments to your taxable income, and that may have penalties as well that follow on there. And then in terms of domestic adjustments, so where the Federal Tax Authority or a taxable person has adjusted the taxable income for a transaction to ensure compliance with the TP rules, then the FTA will make a corresponding adjustment to the related party. And then if there's a foreign adjustment, so where TP adjustment has been made in a foreign country on a transaction that involves a UAE entity, then the UAE entity can make an application to the FTA for a corresponding adjustment to eliminate or minimize the risk of double taxation. So it won't be a default adjustment, but it'll be based on the FTA's own discretion and assessment of the matter. So it's important that taxpayers are aware of this and make that application. And of course, there are various penalties that apply for any non-compliance. Then what TP documentation is required? So we've already touched on this briefly. This is the tax disclosure form that is filed with the tax return. And we'll touch a little bit later on what is required on this tax disclosure form. And again, the master and local file prepared at the time of the tax return. And then Article 59 in terms of clarifications, you may make an application to the Federal Tax Authority for a clarification regarding the application or for an advanced pricing agreement with respect to the transactions that have been entered into or proposed to be entered into.
Tuli, I just wanted to add there, this is one of the most common and simple errors we actually see in transfer pricing, which triggers an audit, that your disclosure form doesn't match your local file or your AFS. It's the easiest way for a tax authority. We have one number in our tax disclosure form. We have something else in our local files, something else in our financial statements. That's the opening of a can of worms. So we shouldn't have segregation of duties around these items. When we look at transfer pricing, we need to look at it holistically, because we've seen, I would say, hundreds of audits based on it. You know, when they go through the process, they're going to look at simple stuff like, does this match? And they see a number of, and then even if you're perfect on transfer pricing and you have all of this, once they've invested in an audit on you, they will invest heavily and they will start to ask a lot of detailed questions and information. Just a point, because it's not so complicated to map all of that stuff, but it is entirely common practice that we do not map and that those numbers are different, and it opens a can of worms. Thanks, Tuli.
Thanks, Cabrini. We can move on to the next slide as well. Okay, so talking about the who. So this slide specifically, it's just talking about the free zone entities like we touched on earlier. So under the UAE corporate tax law, qualifying free zone persons can enjoy a preferential tax rate of 0%, provided that they meet certain conditions. And one of these conditions is that the TP principle, they apply the TP principles, and this is in terms of Article 18 of the law. However, not every free zone business qualifies automatically, and not all income is eligible for the 0% tax rate. So I think that's pretty key to remember. It can be quite easy for one to think that because you're a free zone entity, you qualify for the 0%, therefore there's nothing for you to do. You don't need to worry about these rules. That's definitely not the case. And you know, there's also, I've just added there some quotes from some articles by the general manager of the free trade zone, where it's quite clear that the free zones are also required to adhere to these rules. Transfer pricing is no longer just something of a back office box ticking exercise, but it should be seen as a strategic imperative of every business to ensure that if you engage in any cross-border transactions, that you've got robust, transparent documentation that aligns with the OECD standards. So I think that's quite a powerful message that we need to keep top of mind. So it's no longer just a clerical formality, it's a legal necessity, and it's a strategic safeguard, and it helps to ensure that the free zone entities can retain their 0% tax status. So in order for that to be the case, all the related party transactions must comply with the arm's length principle. The detailed TP documentation must be ready and up to date, and the audited financials must be maintained.
And maybe Tuli, just to add to that, because I think this is really important, not just for the free zone, but for the UAE in general, is one of the biggest items that we'll be looking here is the substance. Do we meet the OECD substance requirements in terms of value creation for the profit attributed to those entities? So that's been linked to the Pillar 2 and global minimum tax. Are we in or are we out? In terms of the free zone, we need to be able to demonstrate OECD economic substance. And that is very different from what we might be used to in company law. You have to have a director, you have to have this. It's about true functionality, authority, and decision making. So that is a specific hot area which we expect to see a significant focus on, because that may be something that is lacking or historically lacking with respect to certain UAE businesses in free zone and wider.
Thanks, Cabrini. All right, and then on the next slide, so still talking about who's subject to the rules. There are some exemptions that apply, but you just have to make sure that you meet those requirements. So for a business that has chosen the small business relief, as well as for standalone entities without related party transactions, you do still need to apply with the TP rules and adhere to the arm's length principle for your controlled transactions or your transactions with related parties and connected persons. But the only difference is you are not required to prepare and maintain TP documentation. Okay, so like we mentioned earlier, so we touched on the TP disclosure form as well as the OECD's 3 tiers of documentation. So this slide is just telling us what goes into each of these documents that we need to submit, prepare and submit. So first up on the TP disclosure form, so this is just that you need to disclose the general taxpayer information, the details of your transactions with related parties and connected persons, the nature and value of the transactions, remembering that at the start we spoke about the thresholds that apply in terms of the consolidated, so the aggregated value of the related party transactions and the value per category. You need to also note if you have applied for any exemptions or relief. Then in terms of the local file, we need to provide a business overview of the local entity. You need to talk about the intragroup transactions, so provide details, the quantum of the transaction and the nature thereof. You need to talk about the local management structure. So as Cabrini mentioned earlier, the significant people and the substance, we need to talk around that. Then the functional analysis. So transfer pricing is about where the profits should be earned, and that depends on who does what where. So you need to talk about the functions that are performed by each party to the transactions, the assets that they use in performing the functions, and the risks that are assumed. Then we also have to have the economic analysis, where you select and apply the most appropriate TP method applicable to the transaction, and you do a comparability analysis or a benchmarking study, whereby you look at the market for comparable entities and comparable transactions, and determine a range of what an arm's length price is, and to conclude on the entity's adherence to that arm's length range. Then in terms of the master file, it also needs to include a business overview, but differently, the master file talks about the group's global operations. You talk about the M&E's intangibles, the intercompany financing activities, and the financial and tax position. And then finally, the country by country report as well. So just in terms of this document, it's applicable for UAE. It needs to be submitted in the UAE if the ultimate parent entity is a tax resident in the UAE. So this document, you have to talk about, or disclose rather, the consolidated revenue of the group, the profit or loss before tax, the income tax paid, as well as the income tax accrued, the capital in the various jurisdictions, the tangible assets that are located, the value of the tangible assets located in the various jurisdictions, the number of employees in each jurisdiction, and as well as the main business activities. So this document is really used as a way of assessing risk across the group. The tax authorities able to see also, who does what way in terms of the business activities, where is the revenue earned, where is the profit sitting, where the assets sitting that are used to generate that revenue, and where the employees that are generating that revenue based. So it's a good risk assessment tool, and it gives tax authorities just a high level overview of the group to be able to allow them to zoom in on where, you know, they would want to expand or explore further. Thank you, Cabrini. Right, so this slide, it's talking about the related parties and connected persons. So we've been talking about the fact that the arm's length principle. So from an OECD perspective, Cabrini mentioned that it applies to associated enterprises. So the associated enterprises term, it's an OECD term, but you'll find that each country has its own terminology that it uses for this concept. And different countries have different definitions. So quite interestingly, in the UAE, it speaks of related parties and connected persons, which is quite unique. Many jurisdictions would have just one terminology. So for example, in South Africa, we talk about connected persons. So there are definitions. So here we're just looking at the distinction between these two terms and the different implications for both corporate tax and transfer pricing compliance. So firstly, for related parties, this is for legal entities or individuals. Okay, so that's the first distinction. Related parties refers to legal entities or individuals with at least, so more than or equal to 50% control or influence over the business. And this includes relatives up to the fourth degree of consanguinity. So the term related party is used for applying the transfer pricing rules, including transfer pricing documentation. And the key compliance requirements, if an entity has transacted with a related party, is that it must apply the arm's length principle. It must maintain TP documentation. So that is the master file, local file, and the TP disclosure, if those thresholds are met. Then when we talk about connected persons, a connected person is an individual who is an owner, director, or officer of an entity. And a connected person is also a related party of such an individual and includes relatives. And this is used for deductibility of expenses. So meaning if a taxable entity has transacted with a connected person, the deductibility of the expenses in the tax return or the taxable income of that entity needs to, that's what the implication is. So the expenses such as the salaries of those individuals or the interest paid to those individuals or management fees paid to those individuals will determine whether or not those will depend on whether those transactions are at arm's length and incurred wholly and exclusively for business purposes.
And I think that's pretty important when we think about it, right? We have transfer pricing adjustments of all of these. If we can't show a cost as arm's length, it's not going to be deductible. So that's pretty torturous. That's pretty torturous thing to be thinking about. So it's quite an important little nuance that they have there. And normally when we have nuances in a local law, it's because they have a specific reason to look at that, i.e. they think they have an issue around this item. So therefore they're going to ensure that that's covered in their local legislation.
Yeah, thanks, Cabrini. And one thing that I also just wanted to mention that I forgot to mention earlier is that there's, the sort of slight difference in the TP documentation is the master local file and the disclosure form is if you've had transactions with related parties. Differently, the country by country report is if the group itself meets that threshold. So you may have a UAE headquartered group. The entity may not have had any related party transactions or connected person transactions, but the fact that it is a headquarter of a multinational and it's headquartered in the UAE, and it meets the threshold, then the CBCR requirements are going to be applicable. But the TP document in terms of the master file and local file and disclosure form, it's if you've transacted with related parties. So I just remembered now to make that distinction. And then if you can quickly jump to the next. Yeah, so just quickly, in the last few minutes, just to talk briefly about the corporate tax rules, just on a very high level. So similarly, these were introduced from the 1st of June 2023. A standard rate of 9% applies to taxable income that exceeds 375,000 dirham, and any income below the threshold is taxed at 0%. That the tax applies to most business activities conducted in the UAE, excluding certain sectors such as the extraction of natural resources. It also applies to individuals that are carrying on businesses in the UAE. The regime places a strong emphasis on economic substance, accurate financial reporting, and compliance with tax registration and filing obligation. And it forms part of the broader strategy of the UAE to align with international tax standards and promote tax transparency. And just a quick summary of the rules. So we've said it's applicable for financial years starting on or after the 1st of June 2023, and it applies to all juridical persons and natural persons engaged in business activities in the UAE. And these are the exempt entities from that. It's government entities, government-controlled entities, qualifying public benefit entities, extractive businesses, and non-resident persons with no permanent establishment or UAE-sourced income. And then again, just to emphasize the corporate tax rate. So taxable income up to 375,000 dirham, it's taxed at 0%, and above that, it's taxed at 9%. And then, like we mentioned earlier, there's also the 15% for large multinationals that are in scope of the OECD Pillar 2 rules, where the consolidated group revenue is at least 750 million euros. Next slide, please, Cabrini.
Okay, thank you, Tuli. That was a good insight into it. Obviously, we're still kind of in the space of an hour, you can give a relatively high level into what's happening. So for business who are just starting to enter, some of you have been through this for a while and have been, working on getting yourself sorted. But in terms of wrapping this up, what you should do and next steps, right? If you're advanced on the journey, you probably know what you need to do. But other than that, we need to identify our compliance obligations. We need to look at our transactions and make sure that we are now, if we fall into the compliance requirements, that we are compliant. That's pretty key, and it would be very difficult to continue doing business there if we're falling short in terms of compliance, because compliance is considered as critical for all businesses in the UAE. We do need to verify our policies. We can't just assume that what we do is correct in arm's length, right? The whole world has changed around us. Historic policies are regularly, on an everyday basis, having to be updated to ensure that we're adherent with global best practices. We obviously need to do the functional and economic analysis, and we need to identify any gaps and pitfalls. Of course, then we need to design a kind of a strategy to manage our risks and our new compliance TP framework that we have to handle, and ensure that our documentation, our numbers, and our legal agreements are being updated so that we've got matching and consistent information. Implementation and monitoring is kind of post the setup phase. We've got to make sure that our numbers are always tying up at the end of the day, and keeping this documentation. There's lots happening. There's still lots happening in terms of Pillar 2. A lot of groups in the UAE are, of course, and it's quite critical, you need to do an assessment of what's going to happen and how could this impact my group or my entity as a result of the minimum top-up tax. Is my structure still aligned with my commercial strategy? There's a lot of thinking to be done when we have such major changes going on in the wider tax world. And obviously, we're here to help. We're here to help, and we want to thank everybody for their attention, for joining us today. Our emails are there. We will be sending these slides around to everyone, and we're happy to deal with any questions or concerns or try to assist you on this compliance journey. Just reach out to Tuli or myself. So Tuli, thank you. And thanks to everybody for joining us. We've had a great crowd today. So thanks very much. And we hope to see you all soon.
Thank you, everyone. Bye-bye.